Hey, Kevin here, top wanted financial advisor and best-selling author, and we are here to talk about the stock market. Today, we need to talk about expense ratios. Yesterday, we talked about ETFs, and we didn't talk enough about expense ratios. So first off, thank you for bringing that up in the comments. Someone had messaged me, I think, on Instagram, say, look, can you talk a little bit more about expense ratios, what's high, what's low, how to really understand them? I'm like, yeah, we should do that because a part of investing in ETFs and any fund is a part of how do you pay for this, right? A lot of times, not all the times, but a lot of times it ain't free. And again, it's the dynamic of investing. There's always cost and benefits depending on what you're looking at. So for example, if I were to buy $1,000 worth of Coca-Cola stock, right? If I were to do that as of today, I can pay $0 in commissions. Okay, whether it's Public, Robinhood, Fidelity, TD Ameritrade, whatever. I can get it and almost never pay a fee to just buy shares of Coca-Cola. Now, there's a risk there. What if Coca-Cola isn't a good stock? That's a risk, okay? Well, that is, no fees, higher risk with that particular company. Maybe it does well, maybe it doesn't. But I can hold it for as long as I want and never pay any fees for it. Well, what happens on the other side? I can lower my risk and get an ETF. Let's say the ticker symbol VUG, the one we talked about yesterday, is a Vanguard ETF, and maybe it has Coca-Cola in it. We're making up an example here, but I do know that there is a fee for having that, and it is 0.04%. This is known as an expense ratio. So I've lowered my risk. Instead of putting everything in Coca-Cola, now I have my money in a bunch of different companies all wrapped in to one thing, but I have to pay a cost for it, and that cost is annual. This is where that expense ratio comes from. It is usually, I've never seen it not expressed this way, but it's expressed as a percentage. So for example, for VUG, and it's just one we're bringing up for an example, is 0.04%, which means for every $1,000 that I have in this fund, I'm going to pay a grand total of 40 cents a year. That ain't bad. This is one of the best things about index funds because it's cheap. Y'all can have that 40 cents. Y'all can have it. Okay? If I'm investing $1,000 with this ETF, I can almost guarantee you're gonna make more than 40 cents. You should anyway, right? So that is what an expense ratio is. Now, here's the other thing. There is a low expense ratio and there's a high expense ratio. Depending on who you ask, anything that is 0.5% and higher is expensive, and there's a reason why some ETFs are expensive and some aren't. There is this school of thought, there is a beef even between styles of investing. We have active funds, actively managed ETFs. These are ETFs that are trying to beat the market. They are buying and selling and doing a lot of tricks and flips to try and do better than the overall market. Then you have the passive investing style. These ETFs are say, look, here are the companies we're investing in, and we're not going to change it because we're passive, and we don't need to do all that much because we think that this style is better than that style, and it'll probably make you more money. This is how Vanguard made its name. So most of Vanguard's funds, VOO, ticker symbol VOO, VUG, if it's investing in the S&P 500, the S&P 500 doesn't move all that much, and it is what it is. There's no moving and shaking. It's just these are the 500 companies. It's going to stay that way. Here's the really, really cheap fee of 0 or expense ratio fee. They're the same thing, but 0.04%. That's it. Don't need to do nothing else. That's how it works. Well, active investing says, well, I think I can do better than that, and I'm going to switch and change and be just as nimble as the stock market. So when something happens out there in the investing space, Russia and Ukraine, inflation, I get to say I'm going to take out these companies and do something different. For example, one of the more famous ETFs out there is the ARK Innovation ETF. That's ticker symbol ARKK. That charges 0.75% for their expense ratio. So for every $1,000 I'm investing, I have to pay $7.50 every single year. And obviously, if you had $10,000, you move to 0, you get the point here. And that's more than 10 times, almost 20 times more expensive than the Vanguard fund that we had mentioned earlier at 0.04% compared to what is, if you're rounding up, close to 0.8%. So 0.75 versus 0.4. You guys at the point. We're doing mental math. We're rounding here. It's almost 20 times more. So you can see that it can be a little expensive, but also you always want to factor in the returns. And the returns for this year haven't, or not just this year, but even last year, haven't been all that great when you talk about the actively managed funds versus the ones that are passive. But also historically, this has been the case. You'll see this tweet really almost every year from CNBC or Yahoo Finance that actively managed investors almost never beat their passive cousins, these passively managed funds. They usually don't, because one, the fee, when you factor in the fee, you kind of come in underwater, but also people aren't all that great at moving and shifting with the market on a monthly basis. It's hard to do consistently over and over and over and over again. Some years, like ARK, it did well in 2020, 2021, not so much. 2022, we'll see. So all those things are going to impact how the funds do, but also you want to pay attention to those fees. You can also, and you should also, pay attention to the fees that you might be paying your 401k as well. The disadvantage here is that you might not have that much power to shift into other areas, whereas if you're on an investing app or you have your IRA, you say, oh look, ARK is paying too much, I'll sell that one and go to this one that pays 0.04 or what have you. So you really get a choice there. And I don't think I mentioned this earlier. The last thing we want to talk about is what's high, what's low, what should I pay, what shouldn't I pay. That's really going to depend on your investing style and really who you're talking to. My bar is 0.5% and above. That's a lot. That you're doing a lot in fees there. And you might be thinking, well, yeah, $7.50 for every $1,000 that I have, that ain't a whole lot, but it adds up. And the more money that you have in it, you're talking, a lot more in fees. And you have to think, year after year after year after year, you could be paying hundreds, if not tens of thousands of dollars over time in fees. That's a sunk cost. You don't get that back. And if I can get a lower fee for better performance, so in this case, VUG to ARK, and those aren't the exact best comparisons. So I'll be honest, those not the best comparisons, but you still get the point, right? Where a passively managed fund that's just, I'm paying 0.04, 0.05, or whatever it is, I'm saving that money and usually getting a better performance. That's money in the bank. So you do want to pay attention to that, and that is how you can understand expense ratios. Again, you want to know what expense ratio you're paying? Type in the ticker symbol, go straight to Google, type in ticker symbol, expense ratio, and 9 times out of 10, it'll be one of the first 2 or 3 search results. But that's it. That's how you understand expense ratios. For those that may be math challenged, I used to be a math teacher. Okay, so I'm not the best at mental math, but in either case, just, because you might be multiplying, typing stuff in at home, remember that if it is a decimal, you have to add that extra because it's percentage. So 1,000 times the 0.04% is 0.0004. So you want to make sure you get those 3 zeros, not just the 1. Get those 3 zeros in there to make sure that you get the right number. All right, that's it for me. I'll talk to you guys later. Bye.